Volatility is arguably the most overused word when it comes to financial news. And simply put, volatility is the measure of how much a stock's price moves. And the higher the volatility, the greater the typical price range of a stock. Since it's measured many different ways, think of volatility as the standard deviation of a stock's price. Remember, when you average data, the standard deviation gives you a measure of how accurate the mean, or the average, is. So if the standard deviation is 2, and the mean of your data is 5, it means the average is 5 plus or minus 2. In our case, we will see the stock price as the mean, 5, and volatility as the standard deviation, 2. So when looking at the price movement of a stock, as long as the price remains between 3 and 7, it would be considered normal because both prices are within the volatility range of 2. Now, it's important to note that volatility is not the same as risk. That being said, this misunderstanding what market volatility actually is one of the main reasons investors tend to sell at the wrong time and over a period of time fail to benefit from their investment. And a good understanding of the principle causes of volatility can alleviate many of investors' fears. So as an investor, volatility isn't a metric that we should be focused on, since it's only a measure of short-term price movement, which shouldn't matter to us when we have 5 to 10-year timelines. Traders, on the other hand, live off volatility. And after all, you can't trade if the price doesn't move significantly over the short term. So what are the principal causes of volatility? Periods of expansion and contraction of new investment dollars due to economic factors, so changes in analysts' economic outlook, anticipation of companies' earnings announcements, so those 3 factors we talked about earlier. And finally, we have to remember that the stock market is emotional. At the end of the day, humans are the ones buying and selling, driven by fear and driven by greed. And it tends to overreact to movements of the fundamentals of underlying businesses and seemingly unrelated events in the economy.